SLOS is calculate and compare the effect of a share repurchase on earnings per share when 1. The repurchase is financed with the company's excess cash, and 2. The company uses debt to finance the repurchase. Financial statement effects of repurchases, changes in earnings per share. So the first thing that we're going to look at is share repurchases using idle cash. So just remember what's going on here, just a quick little accounting lesson. We're going to buy back some of our own common shares. Okay, so the debits and credits is we're going to credit cash and we're going to debit the treasury shares. Okay, so we know assets equals liabilities plus equity. We're crediting cash, cash is going down and equity is going down. Okay, the treasury shares, because we know the normal balance for equity is a credit balance, but treasury shares are a debit balance. Okay, so remember these treasury shares, they don't receive dividends. They don't receive any voting rights, and they're not considered in the calculations for the earnings per share, and that's what we're looking at here right now. So we're just going to look at an example that they have in the text. Takamiya Industries, a Japanese company, has been accumulating cash in recent years with a plan of expanding in emerging Asian markets. The global recession has persuaded Takamiya's management and directors that such an expansion is no longer practical, and they are considering a share repurchase using surplus cash. Okay, so Takamiya has 10 million shares outstanding, and its net income is 100 million yen, and the share price is at 120 yen. Cash not needed for operations totals 240 million yen and is invested in Japanese government short-term securities that earn virtually zero interest. For a share repurchase program of the contemplated size, Takamiya's investment bankers think the stock could be bought in the open market at a 20 yen premium to the current market price, or 140 yen per share. So the current market price is 120 yen, and so you have to add a 20 premium. So the price you're looking at for the share repurchase is the 140 yen. So let's just go through now, calculate the impact on the earnings per share if Takamiya uses all the surplus cash to repurchase the shares at 140 per share. So the solution, first you have to calculate the current earnings per share. It's not given to you, but they've made it nice round numbers, very easy. So we have the 100 million net income. I've put a few things up in bold here so you can go back and see the numbers very quickly, divided by the 10 million shares. So that's easy. The current earnings per share is 10 yen per share. If Takamiya repurchases shares, the net income doesn't change. Remember, in our earnings per share calculations, on a share repurchase, there's no change. When I'm using surplus cash, there's no change to the net income. Okay, a share repurchase at yen 140 a share reduces the share account by approximately 1.7 million shares. So you take the cash available, the 240 million yen, divide by the 140, so it reduces by 1.7 million shares. So we'll just bring up the calculator here to do the calculation quickly. 240 million, 1, 2, 3, 4, 5, 6 on the zeros, and we're going to divide by the 140 yen, and we can see that the company would buy back, it says approximately 1.7 million shares, 1,714,285, make that a negative, add it to the 10 million shares. If we want it to be precise in any type of calculation, we can see that gives 8,285,571. Okay, so you can see the text here is saying that the share repurchase, you're going to buy back approximately 1.7 million shares, so you've got 8.3 million shares outstanding. So after the share repurchase, the earnings per share would be the 100 million. Again, that did not change. Your earnings, net income, did not change because you're just using surplus cash divided by the 8.3 million shares. So your earnings per share would be 12 yen approximately. You can see originally it was 10 yen earnings per share. Now it's 12. So we can see that the earnings per share would increase by 20% as a result of the share repurchase. Note that the earnings per share would increase even more if the open market purchases were accomplished at the prevailing market price without the premium. So remember, the prevailing market price was the 120 yen, but they had to add the 20 premium, so they were buying back the shares at 140. Okay? Continuing with the financial statement effects of repurchases. So again, we're looking at the changes in the earnings per share But in this example, we're looking at share repurchases using debt, okay? The company's going to issue debt, so you're going to have interest charges, and that will affect the net income. So our numerator will change in the earnings per share calculation, okay? So we'll run through this example. Jensen Farms Inc. plans to borrow $12 million, which it will use to repurchase shares. So borrowing money and then going to repurchase shares. And the following information is given. The share price at the time of the share repurchase equals $60. The earnings after tax is $6.6 million. Again, that's going to be affected. The net income, the earnings after tax, is going to be affected by the issuance of debt because you're going to have interest charges. So the earnings per share before the share repurchase is $3. The PE ratio is the share price divided by the earnings per share. 60 divided by 3 equals a 20 PE. The earnings yield, which is the earnings per share divided by the share price, equals 5%. The shares outstanding is 2.2 million, and so the planned share repurchase is 200,000 shares. So just bring up the calculator quickly. We can do that calculation. We can see the company is going to borrow 12 million, and they're going to use that to buy back their shares at the current market price of 60. So 12 million divided by 60, and you can see they're going to buy back 200,000 shares, okay? So now we're going to calculate the earnings per share price after the share repurchase, and so I put in here in bold, the after-tax cost of borrowing is 6%, so that's important. So again, we have to look at the earnings per share after buyback. It's the earnings, and then it's minus the after-tax cost of funds, okay, divided by the number of shares outstanding after the buyback. The number of shares outstanding after the buyback should be fairly easy. You can see that there was 2.2 million shares outstanding before the buyback. They made the numbers nice and round in the example, so it's easy for you. And you're planning to repurchase 200,000 shares. So after the buyback, you're going to have 2 million shares. That's easy, okay? So the denominator is very easy. It's just the numerator here, we have to make an adjustment. The earnings after tax was 6.6 million, but now we have to deduct the after-tax cost of funds. Okay, so how are we going to do that? The after-tax cost of funds is going to be the 12 million that we're issuing times by the 6%. So we can see that's going to be 0.72 million. If I bring up the calculator very quickly, again, 12 million times our 0.06, and you can see that's 720,000. Okay, if I make that a negative, and I add back the 6.6 million of earnings before the issuance of the debt, and you can see it's going to be 5.88 million. All right. So now we're just going to divide by our 2 million shares, and our new earnings per share is going to be $2.94. Okay. So you can see our earnings per share before the share purchase was 3. Now our earnings per share after the share repurchase is $2.94. So note, I made a note here that's very important. If the after-tax cost of borrowing is greater than the current earnings yield, so this was important. We had an earnings yield of 5% that we calculated, but our after-tax cost of borrowing is 6%. So if that after-tax cost of borrowing is greater than the current earnings yield, the earnings per share will go down. If the after-tax cost of borrowing is less than the current yield, like for example 4%, then the earnings per share would increase. And if the after-tax cost of borrowing is the same to the current earnings yield, then the earnings per share would not change. So, you know, if you wanted to, if you've got the time, you could work through this question again and change that to 4% and do the calculations again and see what the earnings per share after the share repurchase would be. But that's the rule that you have to remember. After-tax cost of borrowing greater than the current earnings yield, earnings per share will go down, because sometimes there's some CFA questions where they're not asking you to go through the questions. They're asking you the most likely, least likely that will happen to the earnings per share, and it's these little type of rules that you need to remember, okay? Maybe we'll just take a quick minute to run through that calculation just to really hit that point home. So let's use an example of if after-tax cost of borrowing was 4%. Again, that's after tax. So you have to do the before tax times 1 minus the tax rate, okay? After tax. So 12%, 12 million times 4%. We'd have after-tax cost of borrowing 480,000. Make that a negative. Add that to our 6.6 million of earnings after tax before the share issuance of the debt. And so we'd have earnings of 6.12 million. And we're going to divide now by the 2 million shares that are outstanding after the share repurchase. And you could see that our earnings per share would be $3.06. So the earnings per share before the share repurchase was $3. If the after-tax cost of borrowing is 4%, our earnings per share would increase. So that's just showing you exactly, proving it through the calculation, that if the after-tax cost of borrowing is more than the current earnings yield, earnings per share will decrease. If the after-tax cost of borrowing is less than the current earnings yield, then the earnings per share will increase. So a quick little practice question. Devon Limited common shares sell at $40 per share and their estimated price to earnings ratio is 32. If Devon borrows funds to repurchase shares at its after-tax cost of debt of 5%, its earnings per share is most likely to A, increase, B, decrease, or C, remain the same. I like this question just because it puts a little spin, a little trick, as the CFA often does. And but once you know it, it's fairly easy to answer and to calculate. And again, you have to remember a rule. So it's an excellent little practice question. B is correct. So again, if the price-earnings ratio is 32, then the earnings to price ratio is the inverse. It's 1 over 32, so it's going to be 3.125%. So you can see the after-tax, that's the earnings yield, and they're going to borrow at 5%, which is more than the earnings yield. So we know that the earnings per share is going to decrease. When the cost of capital is greater than the earnings yield, earnings dilution will result from the buyback. Excellent little question because they gave you the PE of 32. You just had to remember, oh, the earnings yield is the inverse. It's 1 over 32. If you haven't seen that before, it might cause you a little bit of confusion. Once you know it, you won't forget it. Good question. So one last practice question to finish this LOS. Crozet Corporation plans to borrow just enough money to repurchase 100,000 shares. The following information relates to the share repurchase. The shares outstanding before the buyback, 3.1 million. The earnings per share before the buyback, $4 per share. Share price at the time of the buyback, $50. After-tax cost of borrowing is 6%. Crozet's earnings per share after the buyback will be closest to A, $4.03, B, $4.10, or C, $4.23. Okay, nice little question to end on because quite a few little calculations you need to do in 90 seconds. So again, speed is a skill. Skill gets rewarded. You need to practice, okay? So A is correct. It's going to be $4.03, but we need to run through the calculations. So one of the things that you need to do, they gave us the earnings per share before the buyback at $4, and they gave you the number of shares outstanding before the buyback. So we need to calculate what the net income or what the earnings was before the buyback because we're going to have to adjust it because we're going to borrow shares at an after-tax cost of borrowing of 6%. So we're going to have to adjust the numerator in this case. It's going to be the net income minus the cost or interest cost, okay? And then divided by the number of shares after the buyback. So quite a few little calculations that you need to do with regards to this question. So let's just start. $4 per share times 3.1 million shares means that our earnings before the buyback was $12,400,000. And the total amount of borrowing is going to be $50 times the 100,000 shares is $5 million, okay? The after-tax cost of borrowing is 6%, so it's going to be $5 million times 6%, $300,000. So far, so good. Basically, don't even need the calculator for those simple calculations. And so you can see that the number of shares that I'm going to have outstanding after the buyback is going to be the 3 million minus the 100,000, which is the 3 million shares. That's really easy because the shares outstanding before the buyback, 3.1 million. They say they're going to buy back 100,000 shares. So that one, again, basically don't even need the calculator for that, we've got our denominator. It's going to be 3 million. The trick here was just getting the numerator. And so the numerator, we had 12.4 million in terms of earnings before the buyback. And then we had to deduct the after-tax cost of borrowing, which is going to be the 300,000. So you can see our numerator is going to be 12,100,000. Okay. So let's just bring up the calculator on that. And so it's going to be 12,400,000 minus our 300,000. And we're just going to divide by our 3 million shares, which are outstanding after the share repurchase. And indeed, I've got the correct answer, $4.03, closest to $4.03. The correct answer is A. Okay. So the PE, just a little bit here, the PE before the buyback, if you just want to finish this off a little bit, $50 price divided by earnings 4 would be 12.5. Thus, the earnings yield, remember, is 8%. So in this case, the after-tax cost of debt is 6%. Therefore, the earnings per share will increase. So a nice little ending to that. Okay, so just remember, the PE is 50 over 4, 12.5. 1 over 12.5 is 8%. After-tax cost of debt was 6%. Therefore, the earnings per share is going to increase. So not too difficult. You can almost do most of that without the calculator. The trick here was just adjusting the numerator to have the earnings before the buyback minus the cost of the interest. Okay, and that's the last slide for this LOS. Thank you.